So the first question you got to ask yourself is home ownership right for you? Um, because it's going to require certain things from you as a potential homeowner. So before you get started on this journey, you got to ask yourself, do I want to be in the same place for at least 5 years or so? The reason, the 5 years, a rule of thumb, is that it will take some saving, some sacrifice on your part to save money for the down payment and or closing costs. There are programs out there that can assist with the down payment, but you should be prepared to make an investment. And if you're going to move somewhere and live there less than 5 years, it may not make sense for you because that you're going to have closing costs, which adds to thousands of dollars. You're going to have to save up for down payment, whether you get down payment assistance or not. So that's usually the benchmark, that if you're going to live only 1 or 2, 3 years, it might not be the best decision for you in that sense because of the money involved. The other one that people have to consider is, do I want to maintain a property? Once you become a homeowner, especially with a single family residence, which is your typical home, there's going to be maintenance that you have to do on the outside of the home. It might be landscaping, mowing the yard, trimming the trees, and such, and also maintenance that you have to do inside the property when things break down, such as the appliances or other small things. Mostly it has to do with plumbing. From my experience, there's ways that you can kind of hedge that. You can always move into a condominium. Condominiums have HOAs, which take care of the outside maintenance of the property. Some townhomes may do the same, but for the most part, if you're going to buy a home, you will be responsible for the inside and exterior maintenance. And especially if you live with an HOA, they're going to have certain requirements that you keep your property, your lawn, your landscaping, just to make sure that the neighborhood looks nice. And that also affects your value. If the neighborhood is well maintained, your home is well maintained, it just gives you that sense of community. So there's other solutions. Like I said, you can definitely move into a condo where the outside maintenance is taken care of for you, and you're responsible for anything inside your condominium. Again, alluding to having to save money, and do I have a savings or emergency fund? What I usually recommend, I'm a loan officer, so what I usually recommend for my customers is to have not only the money that's going to be required to buy a home, the down payment and the closing costs, but you definitely want to have at least 1 to 2 months reserves. Reserves basically means is having enough money set away that if something happens to you, and right now, with COVID, that's a great example. People have been laid off, people have been furloughed, meaning they still have a job, but they can't go to work, and they're not getting paid the same rate they were before, or sometimes their hours are cut back. So you want to have 1 or 2 months reserves to get you through that, that challenge. Which means usually, do I have enough money to pay my mortgage? Do I have enough money to feed myself? And do I have enough money to pay my bills? So these are things that you have to prepare for. And now that we're dealing with the pandemic, it's brought that to light that some people didn't have reserves, and they're kind of counting on that check from the government. And some people, they're still getting help, but they breathe a little easier knowing they have 1 or 2 payments set away should their job be affected. The next one is, how's my credit? That is very important when you're trying to get pre-qualified for a mortgage loan. That is like half the battle when it comes to me. I have to check if people have no credit, bad credit, or not enough credit. Having no credit is easier than having bad credit. Bad credit basically means that you've had credit in the past, and you weren't able to pay your obligations on time for whatever reason. I know things happen. People get sick, people get laid off. But if you don't manage your payments, your current credit well, a bank gets nervous if you're going to be able to afford a mortgage. The way I explain it to my clients is, let's say you have a credit card, and usually the payments are anywhere between $30 to $50, maybe as high as $75. And sometimes people forget to send the payments in on time. Well, the bank is going to look at that and saying, well, if you don't have the discipline to send the payments on time on a $75 payment, how are you going to deal with a $1,200, $1,500, $1,800 payment? So that's why credit is very important. It's basically your track record. And then if you don't have any credit, that's a blank slate. There's things you can do to build credit in 3 to 6 months. One of the more common ones is to apply for a secured credit card. That's a good way to get started. And so keep that in mind. The other thing that goes hand in hand with your credit or your credit score, usually for most programs right now, you need to have at least a 620 credit score, is a calculation that we call debt to income ratio. So you have to keep in mind, how much debt do you currently have? Or also think about delaying some future purchases. The big one that I see that affects most people is their car payment. The car payments, I've seen them run from $250 to $1,000 a month. That car payment is money that could have gone towards your mortgage, and sometimes it keeps people from qualifying when that debt is too high. That car payment is too high. Other than that, people have student loans; those are fairly affordable. Credit card debt, that's the one that can go either way. Most people have low balances and low payments, but I have seen people that have several credit cards with several high payments. And that's gonna, like I said, that factors into a ratio that we call debt to income ratio. Basically, it's how much money is coming in, your income, compared to how much money is coming out, your debts. And that is gonna include all your debts, credit card, student loans, car payments, and your housing payment. So you wanna be aware that if you know you have a lot of debt, you want to maybe start paying down some of those accounts, not for two things, right? One, to qualify, and then to give you peace of mind that as you get rid of some of these debts, you have more disposable income, so you can also save some more money. Back again to how much savings do I have? Do I have an emergency fund? You don't want to, really be in a position where you're only living paycheck to paycheck, and if something goes wrong, you may miss your mortgage payment. Okay, next slide.
Okay, well, let's talk about advantages of home ownership. So real estate purchase is one of the biggest purchases you can ever make, and at the same time, it's one of the best ways to invest your money. When you pay rent, you never see that money again. It just goes to someone else's mortgage. But when you make your mortgage payment, you build your equity, and equity is essentially what you own a home and what you can sell it for. So with every mortgage payment, the equity goes up. And on top of that, property values appreciate over time. So it makes it a long-term investment, a great long-term investment. Long-term stability. Owning a home definitely gives you a sense of stability. It's there for you. You know what to expect. With the rents, you never know if it's going to go up, or if the landlord wants to renew the lease or not. So your home is there, and you have a pretty fixed monthly payment, so you know what to expect, and more predictable housing costs. So same, your mortgage payment will have a fixed principal and interest. Sometimes taxes and homeowners insurance can fluctuate, but usually it's not that significant. So you pretty much know what you're going to expect when you own a home. And it also gives you an increased sense of community. You start building your life around your home. Churches, schools, you start making friends with your neighbors. So it definitely gives you that sense of belonging and freedom, of course. you can do whatever you want to, as long as HOA allows and the city allows, you can do whatever you want to. You can paint the walls, make some changes. That's one of the best things as well. Anything to add, Lena?
No, I think you covered it. So limitations of home ownership. So again, you have to be prepared for this. I do run into customers who I can tell they're not prepared for home ownership because they don't have any savings at all. They don't have any retirement accounts that they can pull from. There's a big misconception out there that there's 100% financing. There's ways to pull that off, but as a rule of thumb, those days of somebody giving you the down payment and paying for all your closing costs are pretty much gone. You usually get the down payment assistance, but you still have to chip in for the closing costs. And yes, sometimes you can get those negotiated through the seller, but if that's your only strategy, you're really limiting your options. So yes, home ownership does require that you plan ahead and have a financial investment on your part. Banks like that because they know that you plan for this. I have to sometimes tell people, okay, you don't have enough savings, tell me how long it's going to take you to save up, at least for the closing costs, and we'll come back and revisit. And, that's up to each individual. They may be able to save in 3 to 6 months, and sometimes they have to take longer than that. What's another one? Again, alluding to the maintenance. If you live in an apartment, pretty much management takes care of everything for you. There's ways to hedge this, part of maintaining. Again, if you live in a condo, they take care of the outside maintenance, the landscaping, the upkeep. You're responsible for, your own repairs inside the condo, but then another thing, there's home warranties out there. Irina knows more about this, but if you really don't like maintenance, you can always buy a home warranty, and that pretty much covers most of your problems. Yes, it's an added fee that you have to pay for, but there is ways to minimize how much you have to do. You can call one of these home warranties, file a claim, and go through that process, and they'll fix it. But the more they cover, the more expensive they are. Let's see, the next bullet point is, could require sacrificing some amenities. Yes, depending on where you want to live. Older communities may not have the nice pools and gyms that are nice, modern, that some apartment complex has. So some neighborhoods have HOAs where a pool is included. Same thing with the condos and townhomes, but it's all about priorities, right? Do I want to be a homeowner and start establishing roots, start building equity? Because you can always join a gym and that'll have the pool and the facilities. The most important thing I tell people, you want to get started with a path of home ownership as soon as possible. Why do you want to throw your rent money away and help somebody else build equity? Obviously, it's a great idea because that's why landlords exist. Housing market fluctuations can make it challenging when you want to buy. True, like now, we're dealing with COVID, so it's presenting opportunities and challenges. The opportunity is interest rates are so low right now. It's amazing. I'm quoting, people with excellent credit and who are putting down their own down payment. They're getting interest rates for 30-year loans at 2.875, 3%. That's unheard of. It's been a long time since we offered rates like that. So that's an opportunity. Now it's more affordable. You can buy more home given the current market environment. But at the same time, there's a lot of instability regarding people's employment. So depending on what industry you're in, either, you have to factor that in if you're in one of those industries that has been affected a lot by, COVID. And that happens, in cycles, not just, with COVID. Economies tend to go up and down. But you always have to have a place to live. That's what I tell people. So I actually see this as more of a positive because there's that predictability in payments from year after year, where if you're renting, regardless of what's going on in the economy, the likelihood of your rent going up year after year is, fairly common. I've never heard of somebody complain about their rent going down. They always complain about the rent going up. So there's some built-in stability when you're a homeowner. And, the most obvious one, again, that 5 year, or do you want to live somewhere 5 years or more, is because, yes, once you buy a home, there is going to be less mobility. You want to be able to build equity. If you buy a home and have to move in 2 years, you'll be lucky to break even, depending on, on what's going on in the market. So that's something to consider if you're in a life stage or in a career that requires for you to move a lot, that maybe home ownership is not for you. But if you think you're ready to set roots and that's where you want to live and you're happy with where you work, then yes, it's definitely, a better long-term option for you. Okay, next slide, please.
Okay, well, responsibilities of homeowners. So Lena mentioned about the repairs a few times now. Yes, things tend to break down in a home. The best thing you can do is set up some funds aside for that to prepare for the worst. And of course, and do some ongoing preventative maintenance. Some of the biggest things are usually HVAC. You would need to change your filters regularly and get the HVAC checked out annually. That's the best way you can do to prevent that from breaking down. And other things like lawn care and checking the gutters, cleaning the gutters and other stuff. So definitely there's some maintenance things that you would need to do to prevent some costly repairs down the road. You will have a mortgage payment, yes. They say no pay, no stay, so you definitely have to make a mortgage payment monthly. There are only two ways that I know of that you can not do it is either till you pay off your mortgage or if you sell the house. Till then, you still have to make a mortgage payment. And that includes taxes and homeowners insurance, and they tend to fluctuate and change, but usually it's not that significant. You also have HOA fees if you're part of a HOA community, and homeowners associations do have the right to foreclose on your property if you don't make those payments. Private mortgage insurance is usually part of a mortgage payment. It's already in there if you have it. Of course, you will have utilities as well, water, electric, and gas, usually some of the common ones. And pest control won't care some of the additional costs that you may have if you choose to. So yeah, you do have to prepare for some of the additional fees to pay.
Okay, upfront costs to prepare for. So this is my area of expertise. The biggest one is the down payment. Basically, that's what is going to be your investment, your skin in the game. Banks, like I said, the days of 0% financing are pretty much over unless you're a veteran, VA loan that has that benefit. And there's also USDA loans, which are the U.S. Department of Agriculture loans, but those are limited to areas out in the country. You have to be in one of those zones to qualify for a zero down USDA loan. Usually the down payment is anywhere, the minimum you can get away with is 3% to 3.5%. In the old days, it used to be 5% for conventional loans, but for first-time home buyers, there is a 3% down payment option. There's a lot of misconception that you need 20%. Yes, that would be ideal. That's a good way to avoid mortgage insurance. But if you don't have 20%, you at least have to come in with a 3 to 3.5%. 3.5% is for FHA, 3% down is for conventional. The next bullet point is closing costs. So on top of your investment of either 3 to 3.5%, which is for your down payment, you're gonna have closing costs that you have to get save up for. Yes, sometimes the seller can help with the closing costs, but depending how competitive the situation is, in other words, if there's other people bidding on the same home, you're going to be at a disadvantage if you ask for all the 3% help. Why 3%? 3%, there's two parts to closing costs. There's the fees that you incur when you do a loan from the bank or mortgage bank, uh, the fees from the government, fees for appraisals, fees for title, and such. And then you're also going to have escrows set up for you. Escrows is basically a term used for this savings account that is established for you for your taxes and your insurance. And roughly, usually we collect about 2 to 3 months of taxes for your escrows and 2 to 3 months of for your insurance on top of a full annual policy. So those are what we really call prepaids. They're collected on your behalf in advance so they can set up those escrows, but they fall under the general term of closing costs. And if you want a rough figure of what that comes out to, that's usually another 3% of the sales price. So when you factor in your possible down payment of 3 to 3.5% down and your closing costs, you're looking at an initial investment of 6 to 6.5% of the sales price. And don't let that scare you. Like, again, there's options where you can get help with the down payment. So in the end, you may need to just have 3% out of your own pocket. And like I said, I've done deals where the seller has paid for the closing costs, and sometimes my customers get in with $1,000 to $1,500 out of their pocket. But like I said, the more savings you have, the more options you are giving yourself. You don't want to count on, that type of deal where everything's going to be given to you, because in reality, you're going to be facing some competition. Home inspection. Home inspection is basically once you make an offer, you're going to have an option period to inspect the home inside and out, top to bottom. You pay a home inspector for that service, and he's going to do all the hard work for you. He's going to crawl around and dig around and test different things throughout the home, the appliances, look for structural deficiencies, and type up a report and give you the facts. And that way you can make a decision whether you want to move forward with the purchase, negotiate some repairs, or cancel. Irina deals more with the home inspection process than I do, because for lenders, that's an optional feature. Reserves, I already alluded to that. Yes, reserves are a great idea to have, because should you get sick, get laid off, get hurt at the job, you have 1 to 2, possibly even 3 months payment to give you enough time to recover, find another job, and so forth. Moving costs, yes, you have to factor that in, that, what's it going to cost to not only transport my items from my rental to my home. Even if you do it yourself, you still probably have to get a U-Haul and buy supplies, boxes, and such. Also think that you may have to put deposits for your new services, for your electricity, for your gas, for your internet and such. So keep that in mind, that you are going to have possibly put down some deposits in order to move in for your new place. And there's the next bullet point, utility deposits. So those are things that you have to factor in when you're thinking of buying. Next slide. Okay, this is my field of expertise again. Understanding purchasing power. Okay, the first bullet point we have here is mortgage payments should not exceed 28 to 30% of your gross income. So the good news is, when I do my calculations to see how much you can afford, there's 2 ratios that come into play. One is really known as your housing ratio, which is the first bullet point, which is basically just your mortgage payment alone. without any other debts. In other words, how much money do I make on a monthly basis? The good news is that we use gross income, not net income, after they take off, your taxes and all these medical things that you're paying for. We're using your gross income, which makes it easier, to qualify for a loan. And most programs require that you don't exceed anywhere between 20 to 30% of that ratio. In other words, you take your monthly mortgage payment and divide it by your gross income, and that's how you calculate that ratio. Other programs, depending on, this is where credit comes into play. If you do have excellent credit, you can exceed those ratios easily. And that's the difference between somebody having an okay credit score. You have to stick to those 28 to 30% ratio on your housing, where if you have excellent credit, you can go as high as 45%. So that increases your purchasing power alone just by having great credit. Same thing on the next ratio, which is known as the debt to income ratio. That is basically your housing payment plus all your other debts that show up on your credit report. So we only factor in things that show up in your credit report, such as student loans, credit card payments, personal loans, car payments. And usually that ratio, when you have average credit score, you're going to be kind of stuck at 38 to 43% debt to income ratio. When you have excellent credit, that ratio, I've pushed it up as high as 54%. So that makes a huge difference how much you can afford if you have excellent credit. You can go from a limitation of about 43, 45% debt to income ratio all the way to 54%. But also it helps to have reserves to push the limit that far. So when we look at your profile, we're looking at credit, income, savings, job stability. We're looking at the whole picture. Yes, credit is probably the most important there. Savings is the next important. But how much you can afford and how much you can go beyond these housing ratios and debt to income ratios is going to depend on how strong the rest of your profile looks. What's your budget? Yes. Usually we stick to those ratios that are mentioned in the presentation. Those are fairly safe. Once you start pushing, exceeding those ratios, it gets riskier, plain and simple. So what I tell people is I always compare their current rental payment, and I always ask them, what's your maximum that you can afford? Let's say somebody's used to paying $1,000 for rent. Usually they're willing to go up another $300 to $400. And that's how I work with clients. I like working with their budget, because the truth is sometimes I get clients that can qualify for much more, but the reality is doesn't mean no good to tell you that you qualify for a $250,000 home when you want to stick to sales price of $200, because that's based on your budget. We want to make sure you stay there and that you can afford and live your life comfortably, not live paycheck to paycheck, and put your dream home at risk. What's the market like? And so one thing you want to know is what's going on with interest rates. That's probably the main one that people tend to concentrate. And then how affordable are homes, in your market. Right now, like I said, interest rates are so low, people can definitely afford to buy more home. I've seen people upgrade when they first talked to me at the beginning of the year versus now. Now they're moving up in sales price because for the same payment, they can afford more home. As far as the Dallas area, the housing market, it's been very stable. It's been growing year after year. Everybody wants to move to Texas. Everybody wants to move to Dallas. So affordability does become a challenge, but the closer you live to Dallas, the more expensive it is. The further you get away, the more affordable it becomes. So that's one thing you want to keep in mind. Next slide, please. Okay, so on this one, I guess everybody can chip in. where to get started? Well, just the fact that you're taking this class is a great way to get started because you're getting some education of what it is to be a homeowner, how to prepare for that. You know, we have these experts that have been helping you throughout the day. So educate yourself, you know, reach out to Dallas Habitat. They offer free online home buying financial education for anywhere, anyone and everywhere. You know, I first volunteered last December and before all this COVID thing, and we had a live class session. So this is the first time we do this virtual. And but yes, there's plenty of information if you reach out to, you know, these nonprofit organizations, to professionals such as myself as a loan officer, to Irina. We can help you. We half of my business comes from first-time home buyers. The other part of my business comes from people who are upgrading or downgrading, right? Second-time buyers or people who want to refinance their homes. But we can definitely help you, point you in the right direction. Consider homeownership counseling. That's what your, you know, Habitat does well. I know they have lots of resources to help you with that. And as far as how much you can afford, you can definitely talk to me. You can talk to a realtor or talk to one of the counselors. They'll help you look at your budget, right? You know, organize it and see where your money is going and where there's room for improvement, where you can maybe trim the fat so you can have some disposable income so you can save. Because yes, buying a home does take sacrifice. It does require changes to your lifestyle.
Not to interrupt, but we are running short on time. So I think we will put your guys' contact information in the chat box and then send everybody they can reach out to you personally to answer any more questions.
Mm-hmm.
So we will have the link to your next session, which is going on now, in the chat box here shortly. And thank you guys all for joining, and thank you presenters for having doing a great job.
Thank you all.
Thank you.